Welcome back to the channel. Today we're diving into the top volume indicators every trader should know. You see it everywhere, you hear about it all the time, but most people don't actually understand how to use it. These tools can help you make more informed trading decisions by analyzing buying and selling pressure in the market. And if you use them right, you can get an edge in the market. Look, I get it, trading is hard. There's so much information out there, and it's tough to know where to start. That's why I created this channel, to give you the tools and knowledge you need to succeed in the market. So today, we're going to break down 3 of the most powerful volume indicators: on-balance volume, OBV, check-in money flow, CMF, and volume-weighted average price, VWAP. Don't worry if you've never heard of these before. I'm going to explain everything in simple, easy-to-understand terms. By the end of this video, you'll know exactly what these indicators are, how they work, and how to use them to improve your trading. First up, we have the on-balance volume, OBV indicator. Now this one's been around for a while, like way before fancy algorithms and high-frequency trading, but don't let its age fool you. OBV is still a powerful tool for traders of all levels. So how does it work? Well, OBV is a cumulative indicator, meaning it keeps adding or subtracting volume based on whether the price goes up or down. If the price closes higher today than yesterday, we add today's volume to the OBV. If the price closes lower, we subtract today's volume. Simple, right? But here's where it gets interesting. See, OBV isn't just about tracking volume, it's about identifying divergences. A divergence happens when the price of a stock is making new highs, but the OBV is making lower highs. This is a bearish divergence and can signal a potential reversal. Conversely, if the price is making new lows but the OBV is making higher lows, that's a bullish divergence and could indicate an upcoming rally. Think of it like this. OBV is like a leading indicator, giving you a sneak peek into the underlying strength or weakness of a trend. Now, OBV isn't perfect. It can sometimes give false signals, especially in choppy markets. That's why it's important to use it in conjunction with other indicators and your own analysis. But when used correctly, OBV can be an incredibly valuable tool in your trading arsenal. Next, we have the check-in money flow, CMF, indicator, developed by the one and only Mark Chaikin. Now this guy knows a thing or two about the market. He's a Wall Street veteran who's been analyzing stocks for decades. And with CMF, he created an indicator that focuses on one thing: money flow. The basic idea behind CMF is that when big money is moving into a stock, the price tends to go up. And when they're pulling money out, the price tends to go down. Makes sense, right? CMF tries to quantify this by measuring the amount of money flowing into and out of a stock over a specific period, usually 21 days. It does this by looking at the closing price in relation to the high and low prices for the day. If the closing price is closer to the high, it suggests buying pressure. If it's closer to the low, it suggests selling pressure. CMF then takes all these daily readings, adds them up, and smooths them out to create an oscillator that fluctuates between +1 and -1. Readings above 0 indicate positive money flow, while readings below 0 indicate negative money flow. The further away from 0 the reading is, the stronger the buying or selling pressure. So if you see CMF surging above 0, it could mean big players are loading up on the stock. Conversely, if it's plummeting below 0, it could mean they're heading for the exits. Now, just like OBV, CMF is best used in conjunction with other indicators and your own analysis. But it's a powerful tool for identifying shifts in market sentiment and potential breakouts. Chapter 3. Volume-Weighted Average Price, VWAP, the institutional trader's secret weapon. Finally, let's talk about the Volume-Weighted Average Price, or VWAP. Now this indicator is a favorite among institutional traders, and for good reason. It gives them a way to track the average price at which a stock is trading, weighted by volume. This means that periods with higher trading volume have a greater impact on the VWAP than periods with lower trading volume. Makes sense, right? After all, when more shares are changing hands, it's a better reflection of the true market price. Now, VWAP is typically used on intraday charts, meaning charts that show price movements within a single trading day. Traders use it for a variety of purposes, such as identifying entry and exit points, setting stop-loss orders, and gauging the strength of a trend. For example, if the price of a stock is trading above the VWAP, it's considered bullish. If it's trading below the VWAP, it's considered bearish. Simple as that. But here's the thing. VWAP isn't just for day traders. swing traders, and even long-term investors can use it to get a better understanding of where a stock is trading relative to its average price. And because it's a volume-weighted indicator, it can help you filter out some of the noise and focus on the trades that really matter. That's it for today's video. We covered a lot of ground, but hopefully you now have a better understanding of how to use volume indicators to improve your trading. Remember, these indicators are just tools. They're not magic bullets, and they won't make you rich overnight. The key is to use them in conjunction with your own analysis, risk management strategy, and a healthy dose of common sense. But if you're willing to put in the work and learn how to use these tools effectively, they can give you an edge in the market. So, start incorporating OBV, CMF, and VWAP into your trading today and see the difference for yourself. And as always, happy trading. If you found this information helpful, make sure to like, subscribe, and hit the notification bell so you never miss an update. Happy trading!